Hi everyone, in this video we'll be going over A-Level Accounting 2022 October-November paper 1-2. This is a multiple choice paper which consists of 30 questions and we're also given a time limit of 1 hour. And in this video as well, we will be attempting to solve this entire paper under 1 hour. Now without any further delay, let's get started. For the first question, we need to figure out which items would be entered in the general journal. The first item is goods taken by owner for personal use. So this is basically drawings, and drawings are always entered in the general journal. So we should be including this item. The second one is goods purchased for resale. So this is the inventory purchased, and inventory purchase should always be recorded in our purchases journal and not the general journal. So we would not be including this item. The third one is purchase of a non-current asset on credit. So some of you might get confused because in the second item as well, we purchased something. In the third item as well, we purchased something. But the difference is in the second item, we purchased some inventory for resale. But in the third item, we are purchasing a non-current asset. And this is not for resale, which means that this should not be included in the purchases journal. Instead, this would be entered in the general journal. So we would be including the third item as well. And the fourth one is purchase of office stationery. We do not normally categorize office stationery as a non-current asset, which means that this should be included in our purchases journal. So this would not be entered in the general journal. We will be excluding this item. So the items that will be entering in the general journal is 1 and 3, which is given in option B. So that will be our correct answer. Now we can move towards question number 2. Why is it important for a trader to distinguish between capital expenditure and revenue expenditure? So capital expenditure are the non-recurring expense or the one-time expense, whereas revenue expenditure is the recurring ones which occur frequently. Now, the very first reason is to apply the realization concept. So remember that realization concept relates to when the revenue should be recorded in our books of accounts. But we're talking about distinguishing between the capital expenditure and revenue expenditure. So these two items do not have any sort of correlation. So this is incorrect. The second one is to know which method of depreciation to use. Now, depreciation is something that is applied to all non-current assets, and non-current assets are recorded as our capital expenditure. So we do not need to distinguish between the capital expenditure and revenue expenditure in order to know which method of depreciation to use. So this item is also incorrect. Then the third one is to obtain a more accurate profit figure. So remember that in order to figure out our profit, we subtract all of our expenses, right? And those expenses are the revenue expenses because we do not include capital expenditure as an expense while trying to figure out our profit. In this way, it is very important to distinguish between the capital expenditure and revenue expenditure in order to obtain a more accurate profit figure, since this only includes our revenue expenditure. So this is the correct reason. So we're looking for only 3, which is given in option D. That will be the correct answer. This concludes question number 2. We can now move towards question number 3. A company purchased a new vehicle for 30,000. So this is the cost. It part exchanged an existing vehicle at a value of 6,500 with the balance being paid by check. So out of 30,000, part exchange value is of 6,500 and the remaining value is paid by check. Let's figure out the remaining value. That's 30,000 minus 6,500. Which results in 23,500. All right. Then the part exchange vehicle originally cost 12,000 and had a net book value of 4,800 on disposal. We need to figure out which entries will be made in the accounts for income statement and bank account. Let's talk about income statement. We are basically part exchanging, which is equivalent to disposing a vehicle. So whenever there is a disposal of non-current assets, we need to figure out whether there is a loss or a profit. And in order to figure out the loss or profit, we just compare its net book value with the value that it obtained at the disposal. And in this case, the value obtained during disposal is 6,500, whereas the net book value is 4,800. We can clearly see that we are getting a higher value, which results in a profit. So there is profit on disposal. And this profit amount is just going to be the difference between our sales proceeds, which is 6,500, and the net book value, which is 4,800. And this results in the profit of 1,700. And profit is always treated as a revenue. So in income statement, we should be recording 1,700 as an income, which is given in option A. Now let's talk about bank account. We are told that the remaining balance is being paid by check, and we already figured out that the remaining balance is 23,500. And whenever we are paying something, it should be recorded in the bank account on the credit side. right? So in bank account, we're just looking at motor vehicle at cost with the value 23,500 on the credit side, which is again given in option A. This means that the correct answer for question number 3 is option A. This concludes question number 3. We can now move towards question number 4. At 31st December 2021, a business had a non-current asset with a net book value of 18,000. It had been purchased during the year ended 31st December 2020. Depreciation is charged at the rate of 25% per annum using the reducing balance method, and a full year's depreciation is charged in the year of purchase. Now we need to figure out the original cost of the non-current asset. Let us suppose that C represents the original cost. Now we need to figure out the depreciation for the first year, which is the year ended 31st December 2020. And we know that this non-current asset had been purchased during the year 2020, which means that there would not be any sort of accumulated depreciation. So we can easily charge our rate of depreciation to the cost. So that will be C times our rate of 25%, which we can write down as 0.25. So the depreciation for the year ended 31st December 2020 is going to be 0.25 C. Now, let's figure out the depreciation for the year ended 31st December 2021. And for this year, we have the accumulated depreciation, which is the depreciation for previous year, right? So our net book value is cost minus the accumulated depreciation of 0.25C. And then we multiply the rate. Here we're applying the rate of depreciation to the net book value because we're told that depreciation is charged using the reducing balance method. Okay, and the rate is 0.25. So that's 1C minus 0.25C, which results in 0.75C, times 0.25, which results in our depreciation for the year ended 31st December 2021 to have the value of 0.1875C. Okay, now we need to figure out our accumulated depreciation, which is just the sum of these 2 years depreciation, which is 0.25C for 2020 and 0.1875C for 2021, which results in our total accumulated depreciation to have the value of 0.4375C. Okay, now the next step would be to figure out our net book value. And net book value is just the difference between cost and accumulated depreciation. In this case, the cost is C and our accumulated depreciation is 0.4375C. And in the question itself, we are told that at 31st December 2021, the non-current asset had the net book value of 18,000. So we can just substitute its value in this equation. So that's 18,000 equals to 1C minus 0.4375C results in a 0.5625C. Now we can easily figure out the value for C. That's going to be 18,000 divided by 0.5625, which results in the amount of 32,000. So 32,000 is the original cost of the non-current asset, which is mentioned in option D. So that will be our correct answer. This concludes question number 4. We can now move towards question number 5. We need to figure out which item is an error of principle. So the first one is no record was made of inventory withdrawn by the owner for private use. So we are not recording this transaction at all, which is an error of omission. This is not an error of principle, so option A is incorrect. The second one is sales returns were credited to the returns inwards account. We're talking about sales returns, which is in fact the return inwards account, which means that this is not an error of principle. This is also incorrect. The third one is the amount shown on the purchases invoice for goods for resale was incorrectly recorded in the purchases journal. So we're just recording the amount incorrectly, which is an error of transposition and not an error of principle. So option C is incorrect as well. And the last option we have is the cost of machinery repairs was debited to the machinery at cost account. The cost of machinery repairs is basically a revenue expenditure, but machinery at cost is our capital expenditure, right? So we are treating a revenue expenditure as a capital expenditure, which is in fact an error of principle. So the correct answer is going to be option D. This concludes question number 5. We can now move towards question number 6. The sales ledger control account of a business had a balance of 17,640. This did not agree with the total of the individual customer accounts in the sales ledger. And the following errors have been discovered. We need to figure out the correct balance on the sales ledger control account. So I'm just going to prepare the sales ledger control account right here. This is the debit side, this is the credit side, and we're given the balance of 17,640. The opening balance is always recorded on the debit side in our sales ledger control account, so that's going to be 17,640. Now, the first error we have is an invoice in the sales journal for 460 had been entered wrongly in the sales ledger as 640. Remember that we are preparing sales ledger control account, and while preparing sales ledger control account, our basis is going to be the journal and not the ledger, which means that this error in the sales ledger will not affect our sales ledger control account. So we can just completely ignore the first error. Then the second one is the credit balances on the sales ledger 470 have been omitted from the sales ledger control account. So this is the balance of 470 on the credit side in our sales ledger. It had been omitted, which means that we need to include this in our sales ledger control account. And it is also going to be included on the credit side. So that is going to be 470 on the credit side. Then the third error we have is discounts allowed have been incorrectly totaled as 310 instead of 325. We know that discounts allowed is posted on the credit side in our sales ledger control account. We entered 310, which is the wrong amount. It should have been 325. So we've already entered 310 on the credit side. Now, in order to cancel it out, I'm just going to enter 310 on the debit side so that the previous error of 310 entered in the credit side will cancel out with this amount on the debit side. And now I'm going to enter the correct amount of 325 on the credit side, representing the actual discounts allowed amount. Now, the fourth error is goods sold to Harry for 690 have been entered in the account of Barry in error. So the error in customer's account does not really get reflected in our sales ledger control account because the sales amount of 690 has been entered correctly in our sales ledger control account, which means that this error should not be corrected in our sales ledger control account. So we're just going to skip it. Now we need to figure out the closing balance, which will be right here. And in order to figure it out, we require the total amount. So let's just total from our debit side. That will be the sum of these two amounts, 17,640 plus 310, which results in 17,950. And this amount will be the total for credit side as well. Now our closing balance will act as the balancing figure. And whenever we're trying to figure out the balancing figure, we're just going to subtract these amounts from the total. In this case, that will be 17,950 minus 470 minus 325, which results in 17,155. So this is the correct balance on the sales ledger control account, which is given in option B. That will be our answer. This concludes question number 6. We can now move towards question number 7. The totals on a trial balance were debit side 500,150 and credit side 500,000. We need to figure out which error could have caused the difference. So we're looking for the error which would cause our debit balance to go up compared to the credit balance. The first one is a cash sale has only been recorded in the sales account. So in order to record this transaction, our cash account should have been debited and the sales account should have been credited. And we're told that it has only been recorded in the sales account. So we have recorded it on the credit side, but we have not yet recorded on the debit side. So if we were not to record it on the debit side, it would just mean that our debit balance would be lower as compared to the credit balance. But in our question, we can see that the debit balance is higher than the credit balance. So this is not the error which would have caused the difference. So A is incorrect. Then the second one is a credit purchase has only been recorded in a supplier's account. So the recording of this transaction would be purchases account debit and supplier's account credit. Again, we are told that it has only been recorded in the supplier's account. So it has been recorded on the credit side, but not on the debit side, which would result in a lower debit balance. But in the question, we are given a higher debit balance, which means that the error in B could not have caused the difference. So this is incorrect as well. The third one is a credit sale, which has not been recorded. So this is basically error of omission. So both the debit side as well as the credit side has not been recorded, which would not cause any difference on the trial balance. So obviously option C is also incorrect. And the last one we have is a credit sale has only been recorded in a customer's account. So the credit sale would be recorded as our customer's account debit and sales account credit. And we're told that it has only been recorded in the customer's account. So only the debit side has been recorded and the credit side has not been recorded, which would result in a higher debit balance, which is the case in our question. So option D is the correct answer. This concludes question number 7. We can now move towards question number 8. A draft statement of financial position for a business showed total net assets of 600,000. The following items were then discovered. We need to figure out the correct total net assets value. So let's start with the draft value of 600,000. And remember that net assets is just the difference between assets and liabilities. So we subtract the liabilities and add our assets. Now, the first item is a long-term loan for 10,000 had not been recorded. This was taken out on the last day of the financial year. So remember that it has been taken out on the last day. So we do not have to pay any sort of interest on this long-term loan, which means that we should not be including this amount in our total net assets value for this year. So we can just completely skip this item. The second one is the closing inventory had been overstated by 20,000. So remember that closing inventory is an asset which should be added in order to figure out our net assets value, but it had been overstated. So we need to reduce it. So that's a negative. So a positive and a negative results in a negative, which just means that in order to figure out the correct total net assets value, we should subtract this amount of 20,000. Let's do that. Then the third item is depreciation had been understated by 15,000. And remember that depreciation's value is subtracted in the assets section. So that's a negative. And it had been understated, which means that this should be increased. So that's a plus. And a negative and a positive results in a negative, which just means that in order to figure out the correct total net assets value, we should be subtracting this amount of 15,000. Let's do that. Now this gives our correct total net assets value to be 600,000 minus 20,000 minus 15,000, which results in 565,000. And this amount is given in option B, so that will be our correct answer. This concludes question number 8. We can now move towards question number 9. A company has produced draft financial statements for the year. It is then discovered that some inventory is damaged and the value must be reduced. We need to figure out what will be the effect. So inventory is basically the closing inventory, and it just means that we need to subtract our closing inventory. In order to figure out the profit for the year, we add our closing inventory, right? So that's a positive, and now we need to reduce its value. So that's a negative. A positive and a negative results in a negative. This just means that the profit for the year is going to decrease due to the damaged inventory, which is given in option A and B. Now let's talk about current assets. In current assets, we add our inventory, right? And we're told that the inventory's value must be reduced, which is a negative, and a positive and a negative results in a negative. This just means that our current assets is going to decrease as well. That is given in A and C. So the correct ones for both profit for the year and current assets is given in option A. That will be our answer. This concludes question number 9. We can now move towards question number 10. A trader took out a 6% bank loan of 30,000 on 1st November 2021 to be repaid in full in 10 years' time. Interest is to be paid annually, and no interest had been paid by 30 April 2022. Now, how should this be recorded in the statement of financial position at 30 April 2022? Let's calculate the months in which we utilize this loan of 30,000. So that's November, December, January, February, March, and April. So that's a total of 6 months, which means that we need to figure out the interest for these 6 months. That is just going to be the loan amount of 30,000 times the rate of interest on that loan, which is 6%. So that's 0.06. Now remember that this would give the total interest for 12 months, but we only require the interest charge for 6 months. So that's times 6 out of 12, which gives our interest for the 6 months to be 900. And no interest had been paid, which means that these are our payables, and payables are recorded in our current liability. So our current liabilities should have the value of 900, which is given in option B. And then we need to record the loan amount of 30,000 in our non-current liabilities, because it is to be repaid in full in 10 years' time, right? So at the date of 30 April 2022, this loan is still going to be the non-current liability for the trader. And that is given in option A, B, and C. So the correct ones for both current liabilities and non-current liabilities is given in option B. That will be our answer. This concludes question number 10. We can now move towards question number 11. In preparing the financial statements, an accrual for rent payable was treated as a prepayment. Now we need to figure out what effect does this have on the profit and current liabilities. So let's talk about accrual for rent payable. So rent payable is basically an expense that needs to be subtracted in order to figure out the profit, right? So that's a negative. And accrual means that this is something to be paid in this particular year. So this is an expense for this year, which should be added as part of our expense. So that's a plus. A negative and a positive results in a negative, which means that this accrual for rent payable should have been subtracted in order to figure out the profit, right? Now let's talk about the prepayment. Again, The rent payable is still an expense which needs to be subtracted, but prepayment just means that it is an expense for the next financial period, right, which should not be recorded in this particular year's financial statement. So we should be excluding it. That's a negative. And 2 negative results in a positive, which just means that we added the rent payable prepayment in order to figure out the profit. So the amount that should have been subtracted was added instead while figuring out the profit, which just means that our profit will be overstated, which is given in A and B. Now let's talk about current liabilities. So accrual for rent payable is something that we need to pay in this particular year, right? So these are the payables, and payables are part of current liabilities. It should have been current liabilities, but we treated it as a prepayment. And while prepayment, it just means that we already paid out the expense, but we are yet to receive the benefits for those expenses. So this now acts as the receivables. And we know that receivables are our current assets. So instead of including this in current liabilities, we included it in current assets, which means that our current liabilities is now understated, which is given in B and D. So the correct ones for both profit and current liabilities is given in option B. That will be our answer. This concludes question number 11. We can now move towards question number 12. A sole trader is preparing his income statement for the year ended 31st December 2021, his first year of trading. And the following information is available. Now we need to figure out his profit for the year. Okay, so the takings banked is just all of the sales revenue that he got, he put it in his bank account. So these are the revenues that should be added in order to figure out the profit, right? So that's 16,400. Then we have payments made to trade payables. So these are the amount that is paid for the purchases made. And purchases are always subtracted in order to figure out the profit. So we're just going to subtract this amount of 8,500. Then we are given expenses for the year, which is again subtracted while figuring out the profit. So we're just going to subtract this amount of 2,900 as well. Then we have balance of trade payables. So remember that trade payables occur for our credit purchases. And remember that this is his first year of trading, which means that all of these trade payables relates to the credit purchases made in this year. And be it cash or credit, purchases are always subtracted. So we're going to subtract this amount of 1,200 as well. Then we have balance of trade receivables, and trade receivables relates to credit sales. And again, remember that this is his first year of trading, which means that this amount of 700 relates to the credit sales made in this year. And be it credit or cash, sales are always added while figuring out the profit. So we're just going to add this amount of 700. Okay, then he took goods for his own use, 1,000 during the year. So these are the drawings. And whenever we're trying to figure out profit, drawings should always be added. So we're just going to add this amount of 1,000. This concludes everything. So now the profit for the year is going to be 16,400 minus 8,500 minus 2,900 minus 1,200 plus 700 plus 1,000, which results in our profit to be 5,500. And this amount is given in option B, so that will be our correct answer. This concludes question number 12. We can now move towards question number 13. The following information is available for the year ended 31st December 2021. We need to figure out the credit purchases for the year. We are given the trade payables at 1st January 2021. So this is our opening trade payables, which means that these are the values for credit purchases made last year, which means that these are not the credit purchases for this particular year. So we should not be including this amount, and excluding anything means we just need to subtract it. So we're just going to subtract this amount of 18,000. Then we have trade payables at 31st December 2021. So this is the closing date, which means that these are the amounts relating to credit purchases made in this particular year, which should be included because we're basically figuring out the credit purchases for this year. So we're just going to add this amount. Then we have discount received. So discount received is basically the amount of credit purchases that we made, but we do not have to pay for it. But in a way, it is also a credit purchase. So we should be adding this while figuring out our credit purchases. Then we have payments to credit suppliers. So these are paid for the goods that we purchased on credit, which should be included while figuring out the credit purchases. So that's an addition. Then we have returns outwards. So these are basically the purchased goods that we return to the suppliers. But in order for us to return it, we first have to purchase it, right? So we obviously made the credit purchases worth the amount of 3,000. So we should be adding this as well. And the last one we have is the contra to sales ledger control account. And let's talk about contra. So there are two people, A and B. If A purchases goods from B worth 2,000 and B purchases goods from A worth 2,000, they basically cancel each other out. So they can basically settle this transaction without paying each other because they each took goods worth 2,000. And this is what contra is, which means that this 2,000 worth of goods was also purchased. So this should also be added while figuring out the total credit purchases, right? So we're just adding this amount of 2,000 as well. Now the total credit purchases is going to be minus 18,000 plus 14,000 plus 6,000 plus 158,000 plus 3,000 plus 2,000, which results in 165,000. This is the correct answer, which is given in option C. This concludes question number 13. We can now move towards question number 14. What is recorded in both the appropriation account and the current accounts of a partnership? The first one is drawings. So drawings is recorded in the current accounts of a partnership, but only interest on drawings is recorded in the appropriation account. So this is incorrect. The second one is interest on drawings. Interest on drawings is recorded in the appropriation account as well as the current accounts of the partnership. So this is the correct one. And the third one is interest on capital, which is again recorded in the appropriation account as well as the current accounts of the partnership. So this is correct as well. So we're looking for 2 and 3, which is given in option C. That's the correct answer. And this concludes question number 14. We can now move towards question number 15. R, S, and T were in partnership, sharing profits equally. T retired as a partner. At that time, the balance on his capital and current accounts total 320,000. Goodwill was valued at 60,000. The partnership assets were revalued upwards by 30,000. So this is the profit on revaluation. Then T agreed to leave 90,000 in the partnership as a loan on retirement. The balance due to him was paid from the partnership bank account. How much was paid to T on his retirement? Okay, so we're just going to prepare the capital account for T. And the opening balance is always recorded on the credit side for capital account. And we are given the total of capital as well as current accounts, which is 320,000. This amount should be posted to the credit side. Then we're told that goodwill was valued at 60,000. Since T is retiring, we only need to record his goodwill on the credit side, right? And the goodwill sharing ratio is basically the profit sharing ratio. And we're told that the profits are shared equally among 3 partners. So the goodwill for T is just going to be 60,000 divided by 3, which is 20,000. So we need to record this 20,000 amount worth of goodwill on the credit side. Then we also know that there was profit on revaluation, which again increases the capital account balance, which should be recorded on the credit side. So for T, the profit is 30,000 divided by 3, which results in 10,000. This should be again recorded on the credit side. Then we're told that T agreed to leave 90,000 in the partnership as a loan on retirement. And the loan amount left to the partnership while a partner retires is always recorded on the debit side. So this should be recorded right here. Now the balance due to him was paid from the partnership bank account. And the remaining balance will be right here. So this is the amount that we're trying to figure out. And we first require the total. So we can just figure out the total by adding these 3 amounts from the credit side. That will be 320,000 plus 20,000 plus 10,000, which results in 350,000. This is the balance on the debit side as well. Now this balance acts as the balancing figure. And whenever we're trying to figure out the balancing figure, we just need to subtract this amount from the total. In this case, that will be 350,000 minus 90,000, which results in 260,000. So this is the balance due to T, which will be paid from the partnership bank account. And this is given in option D, so that will be the correct answer. This concludes question number 15. We can now move towards question number 16. So question number 16 has been removed from the question paper, which means that now we'll be moving towards question number 17. Where is the dividend received by a company shown in its financial statements? So the first thing to remember here is that this is talking about dividend received and not dividend paid. And whenever dividend is received by a company, it means that these are the dividends received from its investment in some other company, right? So these are the receipts which will act as an income for our company, and incomes are always recorded in the income statement. So that is our answer, which is given in option A. This concludes question number 17. We can now move towards question number 18. On 1st January, a company had 300,000 ordinary shares of $1 each and a 10% bank loan of 100,000. On 1st July, the company issued a 6% debenture of 800,000. Profit from operations for the year ended 31st December was 120,000. The company paid a dividend of 0.05 per ordinary share during the year. We need to figure out the profit for the year. So the formula for profit for the year is profit from operations minus finance charges. right? We're given profit from operations to be 120,000. So we'll start with that amount. Now, the next step would be to subtract all of our finance charges, and finance charges are basically the interest paid on our loans and debentures, right? And we can see that on 1st January, the company had a 10% bank loan of 100,000, and our year end is of 31st December, which means that we need to charge a year's interest on this loan of 100,000. So let's figure out the interest on that loan. That will be the loan amount of 100,000 times the interest rate of 10%, which we can write down as 0.10, which gives the interest for this year to be 10,000. And we need to subtract this from our profit from operations. And the next one we have is a 6% debenture of 800,000, which was issued on 1st July, which means that we utilize this debenture for the months of July, August, September, October, November, and December. These are the 6 months, which means that we only need to charge interest on these 6 months. Let's figure that out. That's the debenture amount of 800,000 times the interest on debenture of 6%, which we can write down as 0.06, but this would give the interest for the entire year or 12 months, but we only require the interest charges for 6 months, so that's times 6 by 12, which gives the debenture interest for the year ended 31st December to have the value of 24,000. And we need to subtract this from profit from operations. So now our profit for the year is just going to be 120,000 minus 10,000 minus 24,000, which results in 86,000. This is the answer that we're looking for, and it is given in option B. So that will be the correct answer. This concludes question number 18. We can now move towards question number 19. X Limited recorded the following information in its books of accounts. We need to figure out the effect on the total revenue reserves. Okay, so revenue reserves are our general reserve and the retained earnings, right? So the first one is issue of 10,000 ordinary shares of $1 each at a price of 1.80. So this would affect our ordinary share and the share premium, and both of these are not a part of the revenue reserves, so we can just completely ignore it. Then the second one is payment of dividends of 6,200. So payment of dividends is subtracted in our retained earnings, which is a part of the revenue reserves. So this would just decrease our revenue reserves by the amount of dividend, which is 6,200. Then the third one is transfer to general reserve. So this just means that we're subtracting the amount of 7,500 from retained earnings, which is a part of revenue reserve. And then we're adding that 7,500 back to the general reserve, which is also a part of the revenue reserve. So that's plus 7,500. So the total effect is just negative 6,200. And this negative represents the decrement. So the correct answer we're looking for is 6,200 decrease. And this is given in option A, so that will be the correct answer. This concludes question number 19. We can now move towards question number 20. H Limited uses ratio analysis to analyze its financial performance. On 31st January 2021, the company prepared draft financial statements before it revalued its premises upwards. How did this revaluation affect the company's ratios? So the first one is non-current asset turnover. Let's recall the formula. So that is just the net sales divided by our non-current assets. And we're told that we are revaluing the premises upwards, which is a part of non-current assets, which basically means that the non-current assets value is going upwards. And whenever the denominator value goes upwards, the total value will go downwards. So this just means that our non-current asset turnover is going to decrease, which is given in option A and B. And the next one we have is return on capital employed. So the formula for return on capital employed is profit from operations divided by the capital employed, right? And we're talking about revaluation upwards, which will also be recorded in our revaluation reserve. So our revaluation reserve goes upwards, which means that our equity goes upwards. And equity is a part of capital employed, which means that the total capital employed will also go upwards. Here, our denominator value is going upwards, which means that the total value will also decrease. So our return on capital employed is also going to decrease, which is given in A and C. So the correct one for non-current asset turnover and return on capital employed is given in option A. That will be the correct answer. This concludes question number 20. We can now move towards question number 21. A company purchases its inventory on credit, and we're given the following information. We are now asked to figure out the trade payables turnover in days. So the formula for trade payables turnover is trade payables divided by the credit purchases times the number of days. So that's 365 days. We are given our trade payables right here to be 90,000. Then we're also given information that the company purchases its inventory on credit, which means that all of our purchases is credit purchases. So the credit purchases value is going to be 270,000 times 365, which results in the value of 121.67 days. Now we need to round it off, so that is going to be 122 days. So this is the answer that we're looking for, which is given in option C. This concludes question number 21. We can now move towards question number 22. A business has the following wages policy for its direct workers. We're given standard working hours per week, which is 40 hours. We're given the basic rate per hour, which is $16 per hour. Then overtime is basic rate plus 25%. So that's the basic rate of 16 plus 25% of 16. So that's 0.25 times 16, which results in our overtime rate per hour to be 20. All right. Then the standard production per worker per week is 100 units. So a worker who is working 40 hours a week is expected to produce 100 units. Then the bonus is 4 per unit in excess of standard production. Then last week, Ben produced 115 units and earned 860. We just need to figure out how many hours did Ben work last week. So we are trying to figure out the total hours that Ben worked. And this total hour is going to include the standard hour and the overtime hour. And we already know that the standard hour is 40 per week, right? So the total hour is going to be 40 plus overtime hour. And we're now trying to figure out the overtime hour. All right, so what we can do is that we know that for 40 hours, Ben is going to receive the basic rate of 16. And then for the overtime hours that he worked, he's going to receive the overtime pay of 20 per hour. And then he also made units in excess of 100 units, right? So the extra units is 15 units. And for those 15 units, he's going to receive 4 per unit bonus. So that's 15 times 4. This is his total pay, which is equal to 860. Now we can easily solve this equation and figure out our overtime hours, right? So that's 40 times 16, which results in 640, plus 20 overtime hours, plus 15 times 4, which results in 60, equals to 860. Now 20 times overtime hour is going to be 860 minus 640 minus 60, which means that 20 times overtime hour will now be 160. Now we can easily figure out the overtime hours. That's 160 divided by 20, which results in the value of 8. So this is just the overtime. Now in order to figure out the total hours, we need to add our standard of 40 hours and the overtime of 8 hours, which results in 48 hours. This is the answer that we're looking for, which is given in option A. This concludes question number 22. Now we can move towards question number 23. Which statements are correct about the first in, first out method of inventory valuation? The first one is issues to production are valued at the most recent purchase prices. This is incorrect because we're talking about first in, first out, which means that the first batch of inventories that were purchased, those purchase prices will be issued to production, right? So we're not talking about the most recent, but we're talking about the oldest one. So statement 1 is incorrect. Then the second one is issues to production are valued at the oldest purchase price, which is the correct one in case of FIFO method. So this statement is true. Then the third one is provides a higher profit during periods of inflation. So during periods of inflation, at time 1, suppose our price is 5. At time 3, the price goes up to 6, right? And when talking about first in, first out method, we issue the oldest price to production. So if we're issuing 5 to production, then our closing inventory value is going to be 6. And remember that closing inventory is always added while figuring out the profit. So we're including a higher value, which results in a higher profit, right? So the statement 3 is going to be correct because it provides a higher profit during periods of inflation. Then the fourth statement states that it provides a lower profit during periods of inflation. We have already concluded that it actually provides a higher profit. So automatically our statement 4 is going to be incorrect. So the only correct ones are 2 and 3, which is given in option C. That's the correct answer. And this concludes question number 23. We can now move towards question number 24. A manufacturing business has 2 production departments, assembly and painting. The following information is available. We're given machinery at net book value, its repair cost, its operating hours, and the number of machines for each department. The total machinery insurance cost for the year was 5,000. We now need to figure out how much insurance should be apportioned to the assembly department. So basically, in order to apportion our insurance, our basis is going to be the insured value of each machine. And in this case, the insured value is basically the value of the machine itself, right? And we are given the machinery at net book value. So our apportion basis is also going to be the machinery at net book value, right? Let's figure out the total. That's 150,000 plus 100,000, which results in 250,000. Now we need to apportion it to the assembly department. So let's start with the total insurance cost of 5,000. And the basis is our net book value. And assembly has the value of 150,000 out of the total of 250,000. So that is just going to be 150,000 divided by 250,000, which gives the insurance to be apportioned to the assembly department to have the value of 3,000. This is the answer we're looking for, which is given in option A. That's the correct answer. And this concludes question number 24. We can now move towards question number 25. Which statement about absorption costing is correct? The first one is it allocates fixed cost to a product when it is sold. So this is actually incorrect because no matter which costing we're utilizing, absorption or marginal, the fixed cost will be added when the product is sold. So this is incorrect. The second one is it allocates fixed cost to a product whether it is sold or not. Now this is correct because under marginal costing, only our variable costs are added to a product when it is not sold. But in case of absorption costing, it also allocates the fixed cost no matter whether the product is sold or not. So our correct answer is going to be B, but let's have a look at the remaining options as well. The third one is it increases the cost charged to the income statement. This is not true because we treat both the variable cost as well as the fixed cost as the cost in our income statement, no matter what costing concept we are utilizing. And the last one is it reduces the cost of the closing inventory. It is again not true because we are allocating the fixed cost to the product while including in the closing inventory, which means that it brings the cost up rather than reducing it. So this is incorrect. This concludes question number 25. We can now move towards question number 26. What is equal to the total revenue at the break-even point? So remember that break-even point is the point where the profit is going to be 0. And profit is basically the total revenue minus total cost, right? This should be equal to 0, which means that our total revenue should be equivalent to the total cost at the break-even point. So we're just looking for total cost here, which is given by option C, since it includes both the variable as well as fixed cost. So this will be the correct answer. This concludes question number 26. We can now move towards question number 27. A business manufactures and sells a single product. It is sold for 10 per batch. So this is the selling price per batch. The variable cost is 4 per batch. Let's figure out the contribution per batch. That is just the difference between selling price and the variable cost. And in this case, the selling price is 10 and the variable cost is 4. So the contribution per batch is going to be 6. Then the fixed costs are absorbed based on a normal activity level of 500 batches at 1 per batch. So our total fixed cost is going to be the number of batches, which is 5,000, times the fixed cost per batch, which is 1. This results in the fixed cost to be 5,000. And remember that this fixed cost is not to be changed with the change in level of production or the number of batches in this case. Now we need to figure out the profit using marginal costing if the company makes and sells 6,000 batches. And the formula for profit under marginal costing is just going to be the number of units, but in this case we're talking about number of batches times our contribution per unit, which in this case is going to be contribution per batch minus the total fixed cost. And we are given the total batches of 6,000, so that will be our number. We already figured out the contribution per batch to be 6, and we figured out our fixed cost to be 5,000, and this is not to be changed with the change in level of batches. So it's going to remain constant at 5,000, and this gives our profit under marginal costing for 6,000 batches to have the value of 31,000. This is the answer we're looking for, which is given in option C. This concludes question number 27. We can now move towards question number 28. A company provides the following information for a year. We're given the sales, total variable cost, total fixed cost. Then, to increase the sales volume by 20%, the company plans to reduce the selling price by 10%. Total fixed cost and variable cost per unit will remain unchanged. Now we need to figure out by how much will the profit for the year change. Okay. The thing to remember here is that the total sales, which is this amount, is basically the product of sales volume and the selling price, right? And we are told that the sales volume is to be increased by 20%. So let's increase it. So I'm just going to write down this equation. So our sales volume is going to increase by 20%. So that's going to be 1 plus 0.20 times. We're also reducing the selling price by 10%. So our selling price will now be reduced. So that's 1 minus 0.10. So this just means our sales volume times 1.20 times sell price times 0.90. So this is the new total sales. And we know that the previous sales equaled sales volume times sales price times 1.20 times 0.90. And this value is 400,000, right? So we can just substitute that amount. So our new sales value is going to be 400,000 times 1.20 times 0.90, which results in the amount of 432,000. So that is our new sales value. I'm just going to create a statement here. So the new sales is 432,000. Then we are given the total variable cost, but we're told that the variable cost per unit is going to remain unchanged, right? So total variable cost is the variable cost per unit times the sales volume. And we know that the sales volume is increased by 20%, right? So that's variable cost times sales volume times 1 plus 20%, which we can write down as 0.20. So that's going to be variable cost times sales volume times 1.20. But we know that variable cost times sales volume gives the previous total variable cost of 240,000. So we can just substitute this amount. That's going to be 240,000 times 1.20, which results in the new total variable cost to be 288,000. Let's substitute this amount. Now our total contribution is going to be 144,000. Now let's figure out the total fixed cost. Now we're also told that total fixed cost will remain unchanged, which means that the total fixed cost is still going to remain at 100,000. So the profit for the year is going to be 144,000 minus 100,000, which results in 44,000. And the question asks us to figure out the change in profit for the year, right? Previously, the profit for the year was 60,000 and our new profit for the year is 44,000. So there is a decrease. And that will just be the previous profit of 60,000 minus the new profit of 44,000 divided by the previous profit of 60,000 times 100%. So the decrement percentage in profit for the year is going to be 26.67%. The answer we're looking for will be 26.67% decrease, which is given in option D. This concludes question number 28. We can now move towards question number 29. A business makes and sells a single product. The budget for sales of 5,000 units is as follows. We're given the selling price per unit, variable production cost per unit, fixed production cost per unit, and variable selling expenses. First of all, let's figure out the total fixed cost. That is just going to be the total number of units of 5,000 times our fixed production cost per unit of 18.90. And this gives the total fixed cost to have the value of 94,500. All right. Now the company plans to reduce the selling price to 60 per unit. How many extra units will need to be sold to break even? Let's figure out the break even for the given information. Remember that the formula for break even point is just the fixed cost divided by contribution per unit. We already figured out our total fixed cost to be 94,500. And the contribution per unit is just the sales price minus variable cost. In this case, the selling price is 75. Now let's subtract our variable production cost of 25 as well as the variable selling expenses of 5. So our previous break-even point is going to be 94,500 divided by 75 minus 25 minus 5, which results in 2,100 units. Now let's figure out our new break-even point. And there will only be one change, which is to the selling price. Previously, we used the selling price of 75. Now we will be utilizing the selling price of 60. So again, we start with our fixed cost of 94,500. Then our contribution is just selling price minus variable cost. And in this case, the selling price is 60 minus the variable production cost of 25 minus the variable selling expenses of 5. And this gives our new break-even point to have the value of 3,150 units. And we are just asked about the extra units. So let's figure out the extra units. That will be the total new break-even point, 3150, minus previous break-even point of 2100. So this gives the extra unit of 1050. This is the answer we're looking for, which is given in option B. This concludes question number 29. Now we can move towards question number 30. Which statements about a budgetary control system are correct? The first one is that it is a long-term plan. This is actually incorrect because budgetary control system is for the near future, which means that this is actually a short-term plan. So statement 1 is incorrect, but statement 2 will be correct. Then the third one is it is qualitative. Again, this is incorrect because budgetary control system deals with our numbers, which is quantitative, right? So 3 will be incorrect, but 4 will be the correct one. So the correct statements are 2 and 4, which is given in option D. That will be the correct answer. All right, this concludes all of our questions as well as the entire paper 1-2 for 2022 October-November. If you found this video useful, make sure you like the video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.